Welcome to the first session of our Mergers and Acquisitions webinar series, Best Practices in Preparing for Successful Exit. So I see we already have a number of participants on the line and people are joining. So maybe let's start with quickly the housekeeping items, and then I'll jump into the introductions. To everybody who is not able to join, or if you have to drop off during the session will be recorded and sent to all the participants after the webinar. You'll be joining the session in a listen-only mode during the presentation, but you can submit your questions via chat. So we have a Q&A session at the end of webinar, and we already have a few questions that have been submitted. So without long ado, let's jump into the introductions. My name is Alexey Saltykov, and I lead the post-merger integration practice at Burnie Group, a boutique management consulting firm located in Toronto. And our guest today is David Moran. David has over 20 years in executive leadership roles with extensive experience executing turnaround strategies, integrating acquisitions, building teams, and driving growth. Currently, he is Executive Vice President to Global Shared Services at Consilio, a global leader in e-discovery, document review, risk management, and legal consulting services. In his role, David has oversight over all merger integrations. He was the President and Chief Operating Officer at Exact Data Discovery when it was acquired by Consilio in 2021. David brings a wealth of knowledge around mergers and acquisitions, and today we will focus on his insights about how to prepare a company for a successful exit. So welcome, David, and I'm really excited about our session today.
Thanks, Alexey. Nice to meet everybody, and happy to be here.
Great. So without long ado, let's jump into the question. Maybe just to warm up, could you please describe your experience in bringing companies to the market and integrating firms that which you have acquired?
Yeah. I worked for a company called Carlson Companies that was based out of Minneapolis for 20 years, previous to becoming the president of XDD for 3 years, and then I've been with Consilio now for 3 years. And I think at Carlson, we were owned by private equity. We did two very significantly large acquisitions and a few divestitures. And then at Exact Data Discovery, over the 3 years that I was there, we did 10 acquisitions, and we recapped the company twice. And then also we recapped the company the last time with private equity, and then we're merged into Consilio. And so, through that, I think I've probably been on point for probably 75% has been on the buy side, 25% on the sell side, but have worked with a lot of acquisitions and done a lot of post-merger integration work. So.
Great, and I know we had the opportunity to work together while integrating XDD within the Consilio, which has been a great experience.
Yep.
And so, David, if we think about the leadership of the companies that are going to be brought into the market, so what are the things those leaders can do to prepare their companies?
Yeah, I think that there's a few things that when you start thinking about going to market that are really important. I think number one, you've got to have alignment with the owners and the shareholders about kind of what that means. So one of the things that I see a lot of is companies that are interested in selling or understanding their value in the market, and they start going down that road. They get into that process, whether it's with a banker or whether it's just through preemptive, solicitations that come to them, and get into the process, and all of a sudden there's a price put on the table or a deal starts formulating, and they're not sure really what they want. They're not sure what the price they want, what they're looking for. They're not sure of the value, or they may not be aligned about kind of what outcome they want. Are they looking to continue to run as a company and they're looking for financial investment? Are they looking to step out and away from the business and have someone come in and take it over? Is it a strategic acquisition? Is it, are they going to run alone? So I think that's one of the big things, is being really clear on what kind of outcome you expect. I think the second thing I would say is just really cleaning up your business as much as you can. And that means having a fairly clean set of financials. As PE firms or other firms, private individuals value your organization, they're going to look at the best indicator of future success is past success. And so a lot of times what you'll see is somebody will go, well, here's our projections for the next 12 to 24 months. And immediately when you're valuing these companies, you're going to go back and say, okay, well, first of all, I'm going to look at the trailing 12 months. And ideally, I'm going to look at the past 5 years. And everybody, who's gone through COVID knows, okay, well, there's probably a couple bump years in there, but you're going to look at that. And so having a clean set of financials and really being able to speak to what's happened in your business over those past years, having that narrative and the story, and having a story around, hopefully revenue growing and cost either, staying flat or growing at a slower rate, I think is a really important kind of thing. And then I would also say, third thing I would say is having that kind of selling story. What does your pitch deck look like? And so having a pitch deck where you can lay out, a little bit about your organization, a little bit about, how it's evolved over time, the history and the progression of the company, the lines of business, the value proposition, you have to really start to get that in order. And before you start going out to people and asking them to value you, they're going to say, all right, well, tell me a little bit about your company. So you have to have that pulled together. And then lastly, when you really get to the point of doing it, it's really thinking through intentionally, how and what are you going to communicate to the employees? How are you going to bring them into the discussion? Some people will bring many employees into that. Some will bring very few. But for those people that are closest to the business, it's important that they're aligned with what's taking place. And so what I mean by that is that if we're valuing a business, one of the first things we're going to believe is that in order to keep the customers, we've got to keep the people who hold those customer relationships. Are those people coming as part of the deal? Do they feel good about it? Are they aligned financially with that? So, doing the work up front to make sure that you've got key talent secured and aligned against what you're trying to do is also really important. So I think about those kind of 4 buckets of the things that I would do to make sure that we were ready to go to market. So.
That's great, David. And if you're thinking, just picking up on the topic of employees and people topic, so what are the biggest mistakes you think the leaders can do from the people's perspective when preparing a company for an exit?
Yeah, I think one of them is it's going to get outlawed. I mean, for the most part, you may be able to keep it tight, but so I think one of the things is having proactive and reactive communications. And by proactive, what I mean by that, and I've worked with some communication consultants that gave us a great model, and I still kind of adhere to it. Thinking through deliberately, what things can we tell you today? What things can you reasonably expect, and what things will we have to figure out as we go? And so as we build our communications and change management plans with employees in that sales side, really laying out kind of, hey, here's what we can tell you, here's what's happening, and here's what we want you to understand. Here's what we anticipate will happen and the timelines we will. And guys, here's the things we're going to have to learn as we go. And so having an intentional communication change management, and I think not having that, can really backfire, because then the story tells itself. People hear it through the grapevine, people, whispers, people are traveling, people are in and out of the offices that you're not familiar with. And so people will start, whether or not you hear it, that story is out there. And so I think putting the right story around that, I think is a really big one. I think another mistake that you'll see, folks do sometimes is they'll make short-term decisions on the business that, might harm the business long-term. And so, everybody understands the idea that, hey, we may not go out and buy a new financial system if we're looking at selling. That may not be the right time. But are you continuing to operate and keep your eyes on the business and make sure the business doesn't deteriorate during doing that? Acquisitions and M&A are one of those things that kind of have a little bit of curb appeal, and people get excited about, and everybody wants to be part of them. Well, the reality is you kind of have to keep the majority of the people focused running your business. And so, determining how to do that, you can't have everybody working on it. So having a little bit of a tiger team, or a team that you can designate as, hey, here are the people that are going to be responsible for this, and really taking this to market is also really important. So I think those are the couple things that come to mind, and for me.
Yeah, no, very interesting, and totally agree from the people's perspective. Yeah, if there's some uncertainty, the best people who are living, they will be going first. Dave, if you think about the biggest levers to increase the value of the company when preparing for an exit, what would they be?
Yeah, I think there's a few of them. I think you're paid a premium for having an integrated and efficient operation. So when we go in and look at companies and see that they're highly fractured, things have been bolted on but haven't been integrated. They've got disparate systems. They have, part of the company in one HRIS system, part of the company in another. They have different billing systems. They have different, that really is a sign of, hey, this is going to be complex and difficult to integrate, right? For companies that have wrestled those things to the ground, wrestled those nuisance types of things, that is really looked at, very positively, and I think helps people to really, get the maximum multiple possible. Having things like nuisance lawsuits hanging out there tend to linger, having anything unproductive assets hanging around. If there's lines of business that are dragging your P&L, we inside of our company just got rid of about $10 million of paper business because, at some point we're owned by private equity. We will go to market again. And that's kind of a non-performing asset. It just hangs out there. And so we looked at it and said, we don't think this is strategically valuable to us. We got to get rid of it before we get to the next exit. So I think that's one. I think really, having a story around organic growth is important, right? So, I mean, usually when you're valuing a company, you're going to look and you want to see, kind of that traditional hockey stick of growth. And you want to know that the company's growing and that they've got what you're buying is sustainable into the future. You're buying the future value. And so understanding and having that story around growth and being able to demonstrate that you've been able to do that while controlling costs is important. A little bit different maybe if you're an early stage tech company and you've got IP and unique software that just haven't gotten to market. But if you're a service company, if you're a manufacturing company, if you're technology enabled service, people want to know that, hey, there's some demand for this, and this, you're capable of generating that demand and capturing that demand and having a solid approach and selling strategy around that, and the things that support that, whether that be commission plans, whether that be sales measurement tools and analytics, having a CRM like a Salesforce, et cetera, those kinds of things that are in place are really important. And I think, when you're buying companies, people understand, depending upon the time a company's been in business, the line of business they're in, some of those things may be there, some of them may be not. But, the more you can kind of make sure that you've got your core infrastructure in place and you have a good, solid business, that's what people are going to value. So.
Okay. And so I know that many companies bake in a lot of revenue benefits into the deal, but sometimes they're not necessarily able to get to them. So what's your experience with that category of benefits? Is it something that's normally kind of overvalued, something that's hard to extract?
Yeah, I mean, usually you're talking about kind of like normalizing financials or that type of thing.
Yeah, and also any benefits associated with cross-sell, with upsell.
Oh, yeah. Gotcha. So I mean, I think typically when we look at a deal and we're doing the financials for it, we do post-merger integration. We kind of focus on 3 or 4 things. On the cost side, you've got synergies. We focus on laying out the organization, and we focus on process and systems. How do you put those together? On the revenue side, it's how do you make 1 + 1 = 3, right? So when we're doing the valuations, typically our lenders, look at cross-selling and revenue as upside. It's usually not factored in financially to the deal, where the cost synergies will be. However, it's one of the first things we try and get out of the gate on the integration. How do we take our products and their products? how do we very quickly build messaging and go to market around that and take that story out to the marketplace of why this provides greater advantage to the customer. It might be that we're able to now provide end-to-end service. It might be that we're now able to help them single source to a vendor instead of working with multiple vendors. But we'll look at that and see if we can build a way to talk about that and really capture that share very early. And so the nice part about that is if you can get out to the market early and there are revenue synergies, typically it takes a little bit of cost pressure off the cost synergy piece of the equation. And so that is one of the things we do try and get out of the gate very quickly. It's usually the quickest part of the integration. When you do post-merger integration, which, by the way, I'm a huge fan of, and I'm a huge fan of the Burnie Groups, as you guys know. And from my perspective, the methodology around post-merger integration is fairly similar, regardless of what consulting company you're working with. The quality of the ability of the consultants to work with you across that is super important. And so I think one of the things that we try and do is line up our finance group, their finance group, our HR group, their HR group. I think on the revenue side in particular, getting that, it's usually one of the first groups that we integrate, because regardless of whether or not it takes you 6 months or 12 months to truly integrate, the market's looking for a unified message right away. And so you really have to get out of the gate quickly with that unified message. So.
Yeah, totally agree with that. And so, David, very often companies focus at the very beginning also at very obvious sources of value, like organizational changes, kind of right-sizing of the team. Are there any hidden sources of value that normally leaders or private equity is not really thinking about, but they actually have a lot of potential value associated with that?
Yeah, I mean, depending on the businesses that you're in, I can tell you where we have found value in a lot of these. One of them is on, you think of typical things. I mean, you've obviously got staff, and it's usually finance, HR, and IT. It's kind of the shared service or overhead functions where you find the cost benefits on that side. There's typically benefits on the supplier side, more so if you're manufacturing or you're doing a lot of sourcing, a lot of times technology sourcing. A lot of times we'll rationalize things like our data centers and co-located data centers, real estate. We've had a lot of duplicative real estate across our acquisitions, so that's usually a pretty good source for savings. So those are some of the places that we'll find it. It's not really, I think, very opaque. I think usually the playbook is pretty much there in front of you. As we go into acquisitions, one of the things I would say we try and do is we try and move very slowly, not slowly, but deliberately on customer-facing roles. There's a bit of a mantra of do no harm to the customer equation. We tend to be more aggressive on the finance, HR, IT side, and usually there, we'll look for something like a 25 to 30% cost takeout of the combined company's infrastructure or support costs. And so if their HR is $1 million, our HR is $1 million, they're $2 million together, we'll kind of look at that and say, hey, as a rule of thumb, we think we can get out about $600,000 of that, right? So on the customer side or the selling side, we usually don't assume a lot of synergies, and we will put those groups together, but we'll take the time to get to know the business a little bit and move a little more slowly. However, we won't let it linger forever. We will kind of, over the course of 12 months, put those groups together and make sure that we've got one unified client-facing and client service organization. If that makes sense.
Makes sense. And from your experience, are there any particular levers they can increase the value of the firm, but actually you better avoid them because in the long term, they have potential to destroy some value?
Yeah, I mean, I think short-term decisions that prop up your P&L, buyers are sophisticated and they're going to figure them out, right? So if you're taking short-term actions, so if you're not paying bonuses, like it's always one that'll happen, and you'll see it on occasion where a company won't pay bonuses. Well, in the same way that they'll say, hey, this guy and this guy and this guy and this gal are leaving with the transaction, therefore we're going to take their cost down, we're going to normalize our EBITDA and add that back to our EBITDA. If we see a company isn't paying bonuses, we'll add that back because we'll look at that and go, hey, we know that, there's going to be variable compensation as they come into our organization. And so we'll kind of look at that and say, hey, that needs to be added back. if there is, if their systems are in a place where they're not sustainable, if they're underpaying based upon what we think the market price is for services, that's a place we'll look at. And sometimes you'll see people that'll push off costs or try and do those things. I think things you can do, if you've got vacant positions you're not filling, that's kind of okay if those are positions that you're planning on not running ahead on your own, but you're planning on merging in with someone. Then you might not need to fill that CFO role, and that might be okay. But in the meantime, we would say, and I would say, I would bring in contractors and those kinds of things to make sure that that's there. The last one that comes to mind is you'll also see companies sometimes that play a game with capitalization and expense on assets, and so they'll try and capitalize things that you think are expense, and it's kind of like, again, all that's going to get looked at when even with small companies. We'll have a third-party IT company go in and look at their code. We'll have a financial partner go in and look at their financials to make sure that things like capitalization expense are being handled correctly. So you just want to play it straight up. And I would say my best advice is just be honest and transparent. If you're operating your business on a cash basis, let's say, that's okay. I don't think there's anything wrong with that. Just be transparent about it and forthcoming in the sales process. So.
Yeah, no, I like the transparency topic going through most of your points. So from experience, it just helps to make things easier and integration smoother. So let's now step into the shoes of the PE fund. So if you're a potential buyer of a tech company, what are some of the things you look for to ensure that the price you pay is aligned with the real value of the acquired company?
Yeah, I think there's a couple things, and multiples and on the tech side tend to be higher. Like in our space, they're kind of 10 to 12, which is technology enabled service manufacturing. They're lower. In tech or software as service, you start to go up, 12 to 15 or and above, depending on the software. I think one of the things is, do you have something that's differentiated? Do you have IP? Do you have, is what you're going to market with really, is it easily replicated? Is it automated workflow, or have you built something that really is unique, right? So that's one of the things that I would say, people are going to kick the tires on pretty thoroughly. What is the code base for that? And is the code base solid? Has it been operating for a period of time? So I think that's a big one. On the value prop, it's, if you're early stage, the question that folks are going to ask, and one of the things that happens for me all the time is people will come and go, hey, I've got this idea. We're thinking about going to market with this. Would you be interested in investing in this? I think the question for me is always, does the solution meet an unmet market need, or is it a solution looking for a problem? Because a lot of times you'll have someone go, hey, we have software that does X, Y, and Z. And you're kind of like, great. Are people looking for software that does X, Y, and Z? And are they willing to pay for that? Does it solve a problem that they have, right? So I think, to me, the biggest piece of that is wrapped up in your value proposition. Is it meeting a market need? Can you create differentiation with it? Or is it easily replicatable? Is it something that is available in the market in another form? Can someone come in and cannibalize it very quickly? Those are going to be the kinds of things that I would say that are going to get looked at and scrutinized through that process. So.
Totally agree, because you see a lot of startups that pretty much have an idea, but without proper validation what the problem is actually being addressed, that they're not really driving sustainable growth. And so if you think about key mistakes that companies can make when preparing for an exit, so what would be the top 3 from your perspective?
One of them, I think, is, as I said, just not communicating anything out. One of them is not being ready to do it. It is a big effort. When you go to market, there's a couple different ways you can go to market, right? You can someone come in and make an offer, and you can go talk to them, and I'm sure a lot of people have, and we've done that as well. That can work. The other way is you line up a consultant, maybe a banker if you're larger. They build your pitch deck with you. You go out to market, and you go through this process. And The last one's much more cumbersome than the first one, but even in the first one, if someone's going to spend, millions of dollars buying your company, they're going to spend a lot of time looking under your hood. They're going to spend a lot of time looking in your cabinets. And so you really have to be ready and committed to the time it's going to take, and understand that it will be a distraction. It is going to take away from your ability day by day. And so I think, the kinds of mistakes that I see, number one, are people that kind of get started and then they get frustrated with the kind of information that's being asked. And it's like, well, yeah, it's your business, and yeah, you feel prideful about it, and yeah, you've been running it. But on the other hand, these guys are looking at spending a lot of money. They want to know, about your business. I think, the other one is having, losing sight of your core business and having results deteriorate because you've got key people working on the selling of the company. And so you kind of have to, there's a balance here. You have to have people aligned and understanding. But on the other hand, especially your revenue folks, you want them heads down and selling. You don't want them focused on the sales part of the the selling of the company. You want them focused on selling your products and services and going out to market. So those are kind of the big ones that I see that I think that occur. So.
No, those are all great. And maybe hitting one of the questions that were submitted. So just before the session. So how long before the exit, if I'm an investor, should investors begin planning for the exit?
You mean how long will they hold? How long does PE hold a company? Is that what you're asking? Or how long between starting the selling process and actually completing it?
If I'm an investor and I have an exit in mind, like how long before that exit I should be planning, that kind of cleaning up everything?
Yeah, I think if you're typically, what I see with private equity is the cycle is kind of 3 to 5 years of them holding a company. It can be longer, some hold longer, some hold shorter, but I think it's something in that range. I think if you're selling, typically, from the time you kick off a process, it's a quick process would be 6 months, a long process would be a year. If you're thinking that and you're kind of going, okay, we want to go to market a year from now, you should be getting your stuff in order now as much as you can, right? I mean, the thing with the market, the market was really slow, I think over the past couple of years. It started to heat up here a little bit the last 6 months. And so all of a sudden there's a lot more calls and a lot more inquiries, and we're seeing a lot more. We do a lot of second request work for the US government. We're seeing that pick up where they scrutinize merger and acquisitions. And so to some degree, you can't time when there's going to be demand to buy. You might be ready to sell your company. The market might not be hot, right? And so you kind of, I think, if you're thinking, hey, we're going to sell in the next couple of years or even the next year, I think, you want to be getting into shape as much as you can, because you don't really control the cycles of the market. You can only control your company and how ready you are. So I think my answer would be always kind of working towards just improving that. So.
Okay, that's very helpful. I know we are almost at the end of our session. Maybe 1 or 2 thoughts on the difference between integrating carve-outs versus full mergers.
Yeah, I think, with the biggest one is with a carve-out, you're going to have some kind of shared services agreement, because, when you to me, carve-outs are much more complicated. So when you carve something out, typically there was a billing support for them that might stay behind. There was HR support for that might stay behind. You're breaking systems. And so you almost have to treat a carve out as though you're newly hiring those people into your company, because, unless those kind of platforms come over. Now, it might be different if you're buying an intact division that was really never integrated in a company. But if it's truly like, hey, we're carving out this division, then you've got to be ready to bring them onto your systems and your platforms pretty quickly. And so typically we'll do a 90 to 120 day shared services agreement where that company that we're buying it from continues to provide HR and IT support, et cetera, because you kind of got to move it. It's a little bit like you've got to change the tires on a vehicle as you're driving it down the road, versus an acquisition of a full company where you're moving all their systems. There's nothing saying you can't operate it as it is for a period of time. So you've got governance over that. You've got control over that. So it just makes it a little bit easier. So
totally agree. Yeah, it's a bit of a different beast. Well, David, it was great to hear your firsthand experiences. It was a great session. Thanks for sharing your insights with our entire audience.
Sure.
And maybe as a pre-announcement, so I mentioned in the beginning, it's the very first of our merger and acquisition series. And the next webinar is coming up on May 1st, focused on strategies to source high potential, exclusive mid-market deals. And our featured guest will be Jonathan Tarshes-Neal from Torquest Partners. Thank you again, everybody, for joining our today's session, and we hope to see you on May 1st. Thank you, David.
Thanks. Talk to you, Alexey. Goodbye.